Last week, I was speaking to a business owner about selling his business, and he asked me the question, how easy is it to sell my business? So, in this video, I'll be covering the 5 points that you need to consider when you want to sell your business. And the sixth point will be how you can make your business more valuable and sellable today. When business owners ask me the question to see how easy it is to sell their business, the first thing that I do is I look at their business and how sellable it is. No secret, I've mentioned it plenty of times in this channel, that 80% of businesses do not sell. And the number one reason why they do not sell is because they're not sellable businesses. Now, there's a difference between a good business for the owner and a good business which can be sold. They're two vastly different things. And while a business can provide a good income and a good lifestyle for a business owner while they own the business, you can only sell your business if your business is good to be purchased and to provide value for the buyer who's going to buy it. And there's two types of value that any business has. It's past value and future value. If you can demonstrate that your business has past value that can be moved into the future or that can continue into the future, then your business becomes instantly sellable, and then it becomes easy to sell your business. And the reason why most businesses aren't sellable is because the owners are not able to demonstrate that this past value that has been created for the business owner, who may have started the business and run the business for the last 30 years, that business cannot transfer its value over to a new owner for future income and cash flows. And that's the number one reason why a business is not sellable. So while you might be taking 1,500,000 in profit from your business today, every year, maybe you've been doing that for the last 5 years, maybe you've been netting 1 million in profit for the last 5 years, 10 years. Can that million of profit be transferred over to someone else? That is the question that business buyers ask themselves. And you need to look at your business to see whether that can happen or not. Many business owners, they get shocked when I look at their business and they've got seemingly successful businesses which are doing millions in revenue, but the businesses are not sellable because they attach too much value to the emotional aspect of them creating the business. Many business owners, they've started their businesses from scratch and they've created successful businesses, and that's their baby. And what happens when you take a baby away from a mother, or when you say something which is against the child in front of the mother? The mother immediately gets defensive. The father will defend the child, whether it's emotional, whether it's rational, whether it's logical. And that's what business owners need to take away from their emotions towards that business. Because when a business owner, when a business buyer, when an investor, when a private equity fund is coming to look at your business, they are not looking at the emotional value that you have to your business. They're looking at the commercial value that the business has in a marketplace. And if you can understand that as a business owner and then also demonstrate that as a business owner, that's when your business becomes sellable and you are able to sell it. And the other result, having too much emotion attached to your business, is that you think that your business is valued at a certain number when it may be valued at another number. Now, 90% of the time when I'm talking to business owners and I ask them what kind of value that they think their business can sell for, 90% of the time, their number is way too high. And the reason for that is because they're looking at it from an emotional standpoint. Sometimes I'm surprised when business owners, they actually give a lower number than what it should be. And of course, then I can give them the good news that actually your business is worth more than what you think it is. And that's always a joy, because I like seeing the smile on the face on business owners then. But most of the time I'm looking at business owners and they're like, oh, I thought this business was worth 20 million, but it's only worth 10. How can that be? Right? So I have to then go and explain how valuations work. But that's the other thing that happens, is that you end up overvaluing your business. And then when you try to take it to the marketplace and you're not getting those kind of offers, and it stays on the market for 1 year, 2 years, or you're trying to sell it for 1 year, 2 years, and you can't sell it, then you start becoming disheartened. And when we're talking about valuations, there's two types of valuations. You've got fair market value, which is simple. What's your profit number? Put a multiple on it based on the industry and the size of business and so on and so on. And the other one is strategic value, is that does your business have something which is of real value to someone else that they can't get anywhere else? And then that has some strategic value to it too, which actually increases the valuation. But other than the emotional aspect, what are some of the things that makes businesses unsellable? Number one reason is owner reliance. When a business relies on you as an owner way too much, then that is going to have a negative effect on the valuation. The other clear reason why businesses are, the values knocked down, in fact, they become completely unsellable, is because the finances don't make any sense, right? If you're unable to understand the finances of your business, how can you expect a third party looking into your business to understand what your business is producing? And by the way, we're not just talking about accounts here, we're talking about the activity that your business produces. Are there metrics that you can put to the particular activities, whether that's revenue generation, or whether that's retention, whether that's customer service, whether that's staff retention, and so on? If you're able to put values to them, actual metrics, then that just increases the confidence of your business in the eyes of an investor or a business buyer. The next thing you need to consider when you are selling your business is to turn your business into an actual asset. So what's the difference between a lifestyle business and an asset class business? The key difference is that the lifestyle business is normally attached to individual people. So the owner, his name is John. The bookkeeper, her name is Becky. The salespeople, 3 salespeople, for example, that you've got in the business. The other 2-3 people who deal with fulfillment. The other administrator. You have names who are attached to those roles, but you don't have roles which have names attached to them. So I got this concept from the book Traction, which talks about having clearly defined roles and then inserting people into those roles. Lifestyle businesses have it the other way around. They have people and then they assign them different roles. And then they think to themselves that when this person goes, why has my business fallen apart? If you're able to have clearly defined structures and systems in your business that can run regardless who is inside them. So if Becky, the bookkeeper, leaves and then you have Barbara who comes in, then as long as Barbara can do the same job or a very similar job as Becky did, because you have that role clearly defined and you have the SOPs, the structures that Becky can or Barbara can do what Becky used to do, then your business is a sellable asset. And you need to look at that around your entire business. And if you can do that for yourself as well. Now, as an entrepreneur, of course, you've done things that other people can't do. That's why you're the entrepreneur and they're not. You've taken your business from starting from scratch to 6 figures, then 7 figures, and then 8 figures, and maybe multi 6 figures in profit and 7 figures in profit. Then yes, there are things that you can do that no one else can do. But the key structure of making your business a sellable asset is to create a management team which can replicate what you have done and what you continue to do to the business. Now, that does not mean that you have to find one superstar. You can find 2 people to replace you. Yes, you're going to be paying more in salaries, and that's going to reduce your profit, but it's going to increase the multiple value of your business, the enterprise value of your business, by many, many multiples. Right? And that's what you're looking for. When you want to sell your business, you want to increase the enterprise value by ensuring that that profit that you have is more stable and it can be multiplied by a higher number. That's how you're able to sell a business faster and for a higher value. Because the main point is that when buyers are looking at your business, whether they're another company who wants to buy your business, whether it's an investor, whether it's a private equity firm who wants to go and buy your business, they're looking at the reliability of your business's revenue and profit over risk. So they're weighing up this. The other day, in fact, I think I was just speaking to a business broker. It was either this morning, I think it was this morning. And we had 3 businesses in front of this for me to acquire. And I said, no, maybe. I actually put an offer for the maybe one because I adjusted the risk profile, adjusted the price. So where their price was a lot higher, I knocked it down a couple of multiples because I knew that the risk profile of this business, even though it's much more reliable than the other 2 that I said no to, is much more reliable, there is a risk attached to that. So as much as you can, every investment is a risk, of course, whether you're buying a property, which is a very a low risk business, a low risk investment normally, or if you're buying high value index funds, stocks, and so on, then that's low risk. However, there's still risk attached to that. A private business, when you're selling your business, is much more risky. So the more you can take away the risk from your business, that becomes more attractive to the person who's looking at buying your business. And therefore, you have the higher likelihood of selling the business, you have a higher likelihood of selling the business faster, and you have a higher likelihood of getting the valuation that you want. So risk is attached to a number of areas in your business. The first one is profit. So can this profit stay stable and grow, which is growth is the second one. The third one is risk around your customers. The fourth one is risk around your staff members. And the fifth one is risk around the margins of how you sell your product, or the margins that you attach to your different products. So if you have good stable profits which are generated from products and services which have high margin, and you have a good diversified customer base, and you have staff who are going to stay with you and loyal, at the very least you have structures which you can insert any individual and that role can continue past any different employee leaving. But ideally you have a team which has been with you for 10 years plus. In many cases that's the most valuable. Even 5 years plus is okay. And you're able to demonstrate growth around your margins and growth around your business, then that becomes a much more stable business and a much more stable investment for a business buyer. They look at your business and say, this is something that actually can be taken to the next level because I know they've got a sustainable customer acquisition system. They're able to retain their customers. They're able to do it profitably. The LTV on that is XYZ, wherever that number is. And I'm able to grow it if I do these 5 things. And many times when you're selling your business to someone who can take it to the next level, who can take it further than you can take it. They're the best type of buyers because they're the ones who have deeper pockets, or they can at least raise money. They might not have the cash themselves, but they can raise money from external sources to pay you for it. And that's the difference between fair market value and strategic value, because the more that you can extract from the business buyer, because they see your business in a different light from someone who's just buying it from a purely financial investment perspective, they might say, you know what, I can extract a lot of value from here. So to me, this business is worth X, Y, Z, wherever that number may be. So let's say that buyer values your business at 8 times multiple, where a purely financial buyer might come in and value business at 5 times multiple. If your business is doing less than $1 million in profit, then generally speaking, the max that your business can be exited for is around about 5 times multiple, depending on what industry you're in. If you're in tech and you're in SaaS and so on, that's a different formula. But the most businesses that are selling under $1 million in profit have that. But if your business goes to 2 to 5 million in profit, then you're probably looking at 5 to 8 times multiple on your exit. However, if you're selling your business structured correctly, planned in a right way, planned for sale, and you're selling it to the right buyer, then they might pay you more than that. They might pay you 10x multiple just because they can see where your business can go. So why do some businesses sell faster than others? So the reason why businesses sell faster than others is that, number one, it could be a hot industry where there's a lot of consolidation which is going in. Maybe there's a couple of buyers who are going in and rolling up the marketplace. They will be able to buy your business a lot faster because they're aggressively acquiring in your industry. So you need to look out is that who are the consolidators in your industry, and does your business fit their profile? Because if your business does fit their acquisition criteria, then they will buy your business, and they will be able to buy your business fast. They will typically get a deal over the line between 3 to 6 months if your business fits their criteria. So that's going to make a big impact if there are active acquirers in your industry. Of course, your business needs to fit that profile as well. And generally speaking, businesses which have less than $500,000 in profit don't really fit many people's profiles, right? So any business buyer out there is looking at businesses which are doing multiple 6 figures and 7 figures in profit, then they're going to buy your business, especially if you're looking for private equity. Private equity is looking for 7 figures in profit. There are a few private equity firms which go a little bit below that. If your business is doing over $500,000 in profit, they might look at you, but they're few and far between. Then you're looking at slightly bigger businesses than yourself. Like we are in our industry, that's the salon industry, we are looking at the top businesses in our industry. And yes, there are only just multi 6 figures in profit, not 7 figures, but we do look at groups which are looking to sell. So we are one of the only acquirers in the industry that will do that. But most businesses in the salon industry are doing like 50 grand in profit. No one's buying those businesses, right? The only people who are buying those kinds of businesses are owners who sort of individuals who want to get into the salon industry, maybe own one, and they just want to become an owner operator. But if your business is doing multi six figures in profit and is doing multi seven figures or multi seven figures in profit and eight figures, your buyer universe becomes a lot bigger. And that has a big impact as to how fast you can sell your business. Another main reason why you can sell your business fast is because you've got a good, strong management team. A management team that's been running your business for at least 3 years and is demonstrated in the accounts, the full accounts, the filed accounts, ideally audited accounts, but not always the case, that they can demonstrate stability and growth in your numbers. So if you've got a management team that's been in place for 5 years, 3 years, 5 years plus, and they're showing growth. They're showing growth that whether you are there or not, they can grow the business. Whether you are there or not, operations stay consistent and they stay at a high standard. Whether you are there or not as the owner, that customers leave satisfied and they keep coming back again and again. That is going to be a very positive sign for a business buyer, and they will go and snap up your business very quickly. Another reason, which kind of ties in together with the last one, I'm going to say both of these at the same time. So the lifetime value of a customer. And the lifetime value of the customer is normally a long period of time and also a high number because of the brand of the business, right? So these two things go hand in hand. I can't remember who I was listening to, but someone asked Richard Branson, who's the owner of the Virgin Group, said, what's the most important thing in business? And Richard Branson, he paused for some time, and after some time he said brand. And the reason why I think he said that is because if people value the brand, then they're going to continue to buy from that brand again and again over years. Like I am, apart from my PC, for some reason, I'm very much locked into the Apple brand, right? So I've got the iPad, I've got an iPhone, I've got the headphones, and my wife's got the watch. If I was into the watch, I don't wear watches at all, but if I was into the watch, I'll probably have a watch as well. So I'm very much into the Apple brand. For the PC, for some reason, I'm still locked in, right? So I'm going Windows. And that's brand, which is keeping me to those two brands within those segments of my consumption of those products. So if you have a brand in which you can demonstrate strong customer loyalty to your brand, then your business becomes a lot more sellable because of your brand. And therefore people will buy it a lot easier and a lot faster. So, and this is especially true that if you are selling to someone who's already in your industry, and by the way, 50% of the time, they're the people who are going to buy your business. Someone from your industry is going to buy your business 50% of the time. Even PE, right? So looking at private equity, when they're looking at your business, they've done deals in that industry normally, right? Or they've got people who have done deals in the industry, or they at least know the industry. And therefore, because they're familiar, they will recognize your brand and be like, oh, that brand is a well-known brand in the industry. So therefore, it's come up for sale, or we've created a environment in which we can buy that business. Let's go ahead and buy that business. And they're going to snap up your business as fast as possible. That's why customer loyalty and brand is also going to speed up the process in which you can sell your business. So what's the number one thing that you can do today to make your business a lot more sellable, to ensure that when you want to sell your business, if you want to sell your business now, or if you're thinking to sell your business in the next 2 to 5 years, what can you do today to make your business sell a lot faster when you go down to make that decision to sell your business? The number one thing that you can do is to remove yourself from the day-to-day operations of the business. If you are involved in the sales, if you're involved in the marketing, if you're involved in the delivery of your product or service, if you're involved in the administration or the bookkeeping or the finances, take yourself out of the day-to-day running of the business. And if you're not involved in the day-to-day running of the business, well, let's backtrack. If you are involved in the day-to-day of the business, then what you need to do is that take yourself out of the day-to-day running of the business and you can become the overall manager of your business, right? That doesn't mean the day-to-day manager. We're not talking about you're standing in the business every single day and you're making sure that the products are being delivered or the services being delivered or people are selling. No, I'm not talking about that level of management. I'm talking about strategic management. So you lift yourself out of the operations. I call this an operational exit. So come out of the day-to-day and become a strategic owner of your business. And if you're already a strategic owner of your business, which means that you are not integral to the sales, the marketing, the day-to-day operations of the business, then try to implement a strategic owner to your business. Normally, that's going to be one hire. It's going to be a CEO. You're going to compensate in a very specific way, and it's going to be a rewarding way. Then you can become a true shareholder of your business. If you do that today, you are going to make your business so much more sellable. And it's going to, when you do go to sell your business, it's going to sell a lot faster than you think, because business buyers are looking for that kind of business. If you can do that and lift yourself out of the day-to-day and become a strategic owner or a shareholder of your business, then your business will be very sellable. People are going to go, investors, private equity, other companies are going to come in and they're going to buy your business very quickly. And that is the first step of preparing your business for sale. There are many things that you need to do to prepare your business for sale, but start with removing yourself from the operations. Then you can look at the other areas. And if you need help in that, continue watching videos on this channel and click the link in the description, and we can have a confidential conversation about your business exit. I'll see you in the next video.